Well, good afternoon. It's good to have you here at the Korea Economic Institute of America, and it's going to be my distinct pleasure to welcome you and also to introduce our, I think, extraordinarily distinguished guest who actually happens to be the boss of KEI, and it's in his new role, and we're really excited that he's here to share this 1 hour with us this afternoon. It's appropriate we enter into a new year to discuss challenges facing Korea's economy in 2014 and Korea's growing influence in the global economy. Korea's story is one of great economic success. Korea emerged from abject poverty after the Korean War to become one of the world's most vibrant economies. In fact, within the span of 60 years, Korea has moved from a state dependent upon foreign aid to becoming the 12th largest economy in the world and a member of the exclusive club of developed nations. In fact, the highly respected Financial Affairs Journal recently picked South Korea as one of the 6 hot markets to watch. According to the editors of Foreign Affairs, South Korea has profited from smart leadership and proximity to bigger players, making their manufacturing-driven economies especially appealing for investors. Does this mean that everything is perfect in Korea? No. Economic and political events in other parts of the world can negatively affect Korea's growth. The ending of quantitative easing by the U.S. Federal Reserve, the economic policies of the new Japanese government under Prime Minister Shinzo Abe, the volatility of the North Korean regime, and trade protectionism around the world can all chip away at the economic growth in South Korea. But that's not all. Korea faces domestic challenges as well, from demographic changes to a skills gap in the workforce, which according to the World Bank required Korea to recruit nearly 1.5 million immigrants to fill open positions in 84,000 small firms over the past decade. Our purpose here today is to hear from Korea's preeminent scholar in this field of international economics and the role Korea plays in the global economy. Dr. Il Houng Lee is uniquely qualified to discuss these matters. He was educated in Great Britain, receiving his doctorate in economics from Warwick University in Coventry. Shortly thereafter, he embarked on a nearly 20-year career in different capacities at the International Monetary Fund, working through 2 different periods in Korea's economic history, including the Asia financial crisis in 1997 and the global financial crisis in 2008. Dr. Lee was recently appointed as the new president of the Korea Institute for International Economic Policy, which is South Korea's leading institute concerning global economic issues, and also as ambassador for international cooperation and G20 Sherpa for the Republic of Korea. A pretty busy gentleman. Dr. Lee, we look forward to remarks. He's going to speak for about 15 or 20 minutes, then open up for questions. If you see me waving over there, that'll be the highlight that it's time to take the questions. And then at 3:50, we have another Korean guest, Mr. Samuel Min-jae Cho, who is the chairman of the Kiekman Daily. Is Chairman Cho here? Did he come yet? Okay. And he wanted to make a few brief remarks on Korea's role in the global economy. Dr. Lee, the floor is yours.
Let me get my watch out so that I can keep the time. Will I have the presentation on the screen? Oh, great, thanks. Okay, what I plan to do is spend 5 minutes discussing about the global economy. Next 5 minutes, how the G20 views the current situation, and the following 5 minutes on the Korean economy. So I'll sort of spend 5 minutes each on the 3 topics. They're all interrelated. The first 5 minutes I'll speak as the president of KIEP, because that's our own analysis within the institution. The following 5 minutes as the Sherpa, G20 Sherpa, because that's what we've been discussing at the G20 level. And the last 20 minutes as an economist, independent economist, because these are essentially my personal views. So let me start. Okay, let me start with the challenges faced by G20 economies. It's titled the challenges faced by G20 economies, but essentially talking about the global economy first. According to our outlook, and KIEP is the main or almost the only government-owned think tank in Korea that's responsible for international economy, as well as analyzing the potential impact on Korea, and thus we have our own projection about the global economy that we work closely also with the IMF. And it's not related to me being a former IMF staff. It actually happened before I actually joined the KIEP. So, and as you can see here, next year, global economy will be essentially trotting along. No surprises expected. There's a big question to be asked whether the slow recovery essentially represents a continuing growth or a continuing existence of large output gap, or whether the potential growth itself is now low. The questions are still out there. Nobody knows for sure what the answer is. Advanced economies, but next year most likely will be growing somewhat stronger than EM countries. EM countries face their own problems. I don't think that they have been able to decouple themselves. They still depend on advanced economies. So depending on what happens on the advanced economies, EM countries' economic growth will be affected, and large part also through how fast the tapering will take place. Oops. So slightly positive economic outlook globally next year, led by advanced economies, but there are essentially 5 risks. I'm not going to go through all this in detail, but essentially the questions that I'm asking myself is, will the US recovery be sustainable? And obviously it will be dependent on several key factors, the answer to which I am not fully versed, and I'll cover this in a minute. And then the second is, has Europe bottomed out in reality, or will it continue to slide downwards? Again, there are many assumptions that one has to address before one can answer this question. Then third, will China opt for reform or growth? Here, the outlook, we can be a little bit more certain on the actual outlook if we know what the policy decisions are, because the economic growth in China is largely pretty well determined by what policy actions the Chinese authorities will be taking. And then can Abenomics jumpstart growth engine in Japan? Again, here there are many conditions and one has to ask first. And then 5, what has been the source of economic growth in emerging economies? It relates to have they fully decoupled themselves from advanced economies or not? And if not, what has actually led to recent strength or recent weakening following strength in economic growth for a couple of years immediately after the Lehman crisis. U.S. recovery, fiscal consolidation versus shale gas benefits. Part of the in order to answer whether U.S. recovery will be sustainable, we have to ask ourselves: how fast will the fiscal consolidation be, and also will the impact from shale gas benefits be larger than what the recent report seems to indicate? So, depending on where you which aspect you emphasize, recovery could be sustainable. But if you look at over the medium term, again, the outlook doesn't indicate that there will be any certainty in one direction or the other. There's still a lot of consolidation that has to take place, particularly if the new health plans and the pension payouts based on demography has to be financed in some way. That means that the non-health part and non-service part of the government spending has to come down quite rapidly over the next 10, 20 years. It's not quite clear whether that will be sustainable. It partly depends on whether the economic growth can sustain itself. So a lot of ifs there. But this, the point that I just want to point out here is that U.S. recovery, whether it's sustainable or not, is not a guaranteed outcome, and there's a lot of ifs that has to be satisfied. And then the second question is monetary policy normalization versus higher cost of funds. Again, if you look at the average US real interest rates, depending on the maturity structure, in real terms, it's essentially the T-bill or T-bond rates discounted for by CPI. A very simple calculation shows that in order for the current interest rate to return to 50-year average in real terms, on the short end side, interest rate has to increase by 100 basis points. On the medium long-term side, it has to increase by 250 basis points. If that happens, what will the impact on balance sheets, financial system, as well as corporate sector, not only in the United States, but in the rest of the world? So, and how fast will the normalization take place? That's a big question that has to be asked. And it's not necessarily the case, it's not necessarily that the speed of tapering can actually control this normalization. Here it's on the table on the right-hand side. This is from the CSO. You can see that CSO assumption itself is showing increase in nominal interest rate from 0.5 in 2013 to 3%. That's about 250 basis points, which is what I was just indicating. And the additional dynamics that we have to consider is the way that the US deficit, particularly on the external side, is financed at the moment is because there's a huge demand for FX liquidity outside the US. But once tightening or normalization takes place, this recycling of the dollar funding will taper off itself. So that will be another sort of drag on the US economy. But I'm not going to go into too much details here. And this is just background data. Europe bottomed out? Well, it partly depends on whether financial fragmentation can be stopped, reversed, partly, or in aggregate, whether the financial market itself or the banking system capital can be raised very quickly, or to what extent deleveraging has to continue. To what extent fiscal consolidation can be slowed and reversed. As you know, in G20 there is discussion, some tension between the US and Europe in terms of how fast fiscal consolidation should take place and so on. And the data here seems to indicate that European banks' credit conditions have eased, but it still remains above zero, which is it's still relatively tight. So it's easing, but not quite sure whether it really has bottomed out. On the supply side, again, supply side remains sluggish, reflecting weak investment. Expectations have actually gone above zero, which means it's now slightly positive, but still the actual ones are lagging behind. Europe is definitely gradually reaching its bottom of the cyclical development, but it's not quite clear whether next year it means there will be a recovery or not. And partly the result will depend on whether banking union and fiscal compact can be successfully completed. And I think this is a very critical two components for medium-term sustainability of the euro system itself. So without these two conditions satisfied, I think what might happen is that European countries may be able to recover relatively quickly, but at some point in the future, the same problem will arise again unless one can assure constant relative unit price across European countries. China's past reform versus long-term gain, reform and long-term gain versus short-term gain. Here, the trade-off is relatively clear. And I can say this with a certain degree of comfort, having spent the last 3 years in China and have looked into the Chinese economy. The economic outlook or the economic performance in China is very heavily dependent on government policies. And if there's a decision for the government to delay its reform and emphasize more the short-term growth, then I can assure that there will be short-term growth. But the cost is that essentially delaying the reform to the future, and the reform magnitude that has to be dealt with in the future will actually start growing. And it will be in the form of increasing NPLs, in various forms. It will not be captured very easily in the banking data, but it will be reflected somewhere in the economy as a debt weight, and then at some point will be revealed. Investment to GDP ratio, we came up with some estimate that it should be around 40% for Chinese economy to be sustainable. The actual investment is about 50%. It depends, it varies a lot across regions. But on average, what we found was the East Coast areas where economic development is relatively advanced. Investment there seems to have good traction. But in non-Eastern provinces, where investment tend to be even higher, traction is very poor. So there's a lot of weight seems to be going on, which seems to accumulate, and at some point, somebody has to pay the price. Oops. On Abenomics, let me just point out one thing. One of the things that actually drove the economy, the recovery in Japan through Abenomics was the wealth effect from stock exchange. But if you look at what happened actually in the stock market, is that during the last 12 months, we saw a sharp increase in the stock prices, and thus wealth effect, and thus consumer confidence build up and increase in demand. But the composition of sales and purchases, once you actually start looking at into this in more detail, makes you feel a little bit uncomfortable, because essentially what happened was there was a lot of non-resident purchase of Japanese equities, and very an equivalent amount of sales by domestic investors. And as foreign investors were coming in purchasing these equities, they were actually shortening the yen positions at the same time. So what that tells you is, okay, if there is some problem in the global financial market, we'll pull out. And meanwhile, the Japanese investors, who we thought were, the behind the confidence building, were actually not the case. They were actually pulling their money out and investing outside in sovereign fixed income markets. So you may wonder, okay, why are they doing this? And behind that, it's largely the Japanese banks. So if tapering, something goes wrong in the process of tapering, and there is a dollar market tightening, investors, non-resident investors who decide, okay, maybe it's time to pull out, who already have hedged their foreign exchange positions, you will leave a large gap there. And what we found out was a simple estimation based on past elasticity indicated if they were to pull out in a matter of about 3 months, equity prices could fall very rapidly. It will have a negative wealth effect, reverse the trend. Then if you add on to this the consumer tax next year, there could be some problems. I'm not saying that this is the likely scenario, and we are not taking this as a baseline scenario, but all I'm saying is that this is a possibility that one has to actually watch out, and it's part of the tail risk. Advanced countries' normalization of policy stance, that means both monetary and fiscal, impact on EMs, and there are essentially 4 types of EM countries in this regard. One is those with structural problems, building structural problems as they expand. It's typically sort of China case. Then EMs, those who have been accumulating problems internally, sort of a Dutch disease cases, commodity exporters, for example. A lot of strong demand in commodity resources. Then commodity prices went down in the last couple of years, even though lately it has been coming down. They will start facing problems. The third type of problem is the classical BOP pressures, expansionary policies. Consumption went up because FX constraints were relaxed because of abundant dollar liquidity in the global economy. Once that normalizes, they will have the classical BOP problems. And the final type are reversing back to low potential growth. Those are largely countries where they had temporarily a boost in demand, but the type of foreign investment do not have systemic risk domestically, and thus what happens is that once the liquidity condition normalizes, the economy will revert back to more potential growth, which is much slower than what one was led to believe. Okay. And then more fundamental issues, and these are the issues that we raise in, at G20. And I think I've already overshot my time commitment, so I'll be very, very quick. The question that we have been asking in G20 for the last year or so is the pace of recovery. Is this normal? And of course, the banking crisis, usually if it was severe, then the recovery takes much longer. So it's not a surprise that the recovery is taking so long. But the question that we have is this slow recovery normal? And then we decide to address this problem. We're not quite sure whether it's normal or not, but it's too slow. And that's essentially the conclusion that we came up at the G20 level. Said it's not successful socially, it's economic cost is building up. So then the second question, okay, if that's the case, is it cyclical or is it structural? That was the second question we asked ourselves. If it is cyclical, then can rebalancing help create durable demand? Well, rebalancing, as you know, will help make sure that some countries' demand strengthen, some countries' demand weaken, so that the overall global demand remains sufficiently robust in order to generate or pull out the economy from a cyclical recession. And thus are interested in rebalancing. But if you look at the overall savings, and then the current account balance, and that's where the rebalancing has to come from, then you can actually see that the EM countries' savings has been rising very rapidly as share of world GDP. Advanced countries, seven most advanced countries, savings have been falling. So there seems to be definitely the case, if you just look at these charts, that there is a case to be made to rebalance, to ensure that the global economy's demand remains robust. However, if you look at the second chart, which shows actually consumption in percent of GDP, global GDP, then you will suddenly realize, oops, maybe we missed something, because major advanced economies, G7 countries, aggregate demand as a share of global GDP is actually falling. While the aggregate demand consumption from EM countries is actually rising very sharply. So then the question becomes much more complicated. Okay, then maybe simple rebalancing will not help, because the reason that rebalancing took place was because simply growth in EM countries was too rapid, beyond the consumption growth. But consumption itself was very rapid too. So if EM countries start to slow, then the question becomes not only a rebalancing, but it also becomes more, okay, how do we ensure that this slowing growth in EM countries does not necessarily accompany slower consumption itself, because consumption was growing already very fast, and it was partly dependent on the fast growth in GDP itself. But there is certainly a case to be made that investment has to increase. But again, this is not a straightforward issue, because it's more of a reallocation of global resources rather than whether it's, we should raise overall investment or not. So again, once you start looking at these things in more detail, things become very complicated, and it's not very clear how the global economy can actually cooperate in order to address all these issues. If the problem is structural in nature, then fiscal stimulus may not have much traction at the time of scarce public resources. Okay, so you know this argument. If one were to be convinced that as long as the global economy can provide adequate, robust demand, let's say for the next 2-3 years, in order to jumpstart the global economy, then I'm sure that all countries will be willing to do this. But the problem is, if the real problem is structural in nature, then if the global economy were to agree on this stimulus, then 2 years afterwards, everybody will be worse off. So there is this risk, and thus we have to ask ourselves: is it really structural, or is it, cyclical? So, and the answer is not very clear. Let me just skip here. And part of the reason why we think the answer is not that straightforward is because if you look at corporate profits. And this is just the US, but I can assure you this is not only the case in the US, but generally the case in all G20 countries. Corporate profits have been increasing. And if there is sluggish economic growth, expansionary fiscal policy, why is it that unemployment is not falling except the corporate profits is rising? It begs the question of whether there is enough competition in the product market. At the same time, unemployment is very high, particularly the youth, and it remains relatively robust, even though participation rate is declining. So many young people are leaving the labor market, but then even then, unemployment is relatively sticky. Wages have been declining and inequality growing, and this begs the question whether the income inequality itself is now starting to impede demand creation. So if you have, for example, a very simple example is if poor people get less and less of the income share and rich people get more and more income share, then the demand, the period afterwards will be lower because the marginal propensity of consumption, the higher people, much lower than those in the poor. And at some point, the degree, if you go beyond certain threshold, then that could actually impede economic growth altogether. And actually, there is some empirical study that's been done recently that shows a non-linear relationship between these two. I'm not going to go into details, though. The problem with SME financing, again, if the market is relatively competitive and working normal, why is there not enough funding going to SMEs? SMEs usually have higher risk, but then why are these risks not properly priced, and why is there no market created for SMEs? Anyway, these are all problems that we don't know the answer for. Lastly, let me now conclude by showing you a few slides in Korea, just to indicate that the problems that Korea faces are very similar to the rest of the G20, as I'll show you. Let's start with GDP growth. Korea's GDP growth was well above world average until about mid-2000s. Since then, it sort of was growing at the average speed of the global economy, and more recently, however, we have the global economic growth in Korea have started falling below the global average. So Korea has some economic problems at the moment that in that it sort of slows. It could be a temporary phenomena, but definitely this is what we are seeing now. Part of the reason is because our dependence on export is growing, but the latter has been waning. So it's a very export-dependent economy still. And in terms of the share of trade, it's become increasingly more so in the last couple of years. But export growth is slowing. So thus, it's very natural to expect that the economic growth is also affected. Real effective exchange rate has been appreciating since the crisis. Yet that's not fully reflective of what's going on the trade side. Both export and imports are very poor. And largely, the current account surplus is increasing, but that has more to do with drop in domestic investment overall. And this, again, I showed you earlier that we have investment problems, but at the global level, it's not. It's the reallocation issues. Certainly, Korea seems to be one of the countries that needs to raise investment rather than otherwise. And the sudden drop in investment is slowing economic growth, compounding the negative impact from slowing exports. And that's actually what's driving up the current account surplus at the moment, despite what's, of course, there may have been some impact from the exchange rate. But again, on that one, we're not quite clear because against the yen, Korea's won has been appreciating a lot recently, but that's not reflected on the trade side. So whatever seems to be happening on the trade side doesn't seem to be directly related to the real exchange rate that's going on in Korea. Because even imports vis-a-vis Japan has actually been negative, even though Korea won against Japanese yen has appreciated a lot. So supply chain indicates growing diversification of cross-border vertical integration. So even if you account for this, the Korea's dependence in real value-added terms is actually growing. Let me just skip here because all I wanted to show is that the characteristics that I described for the G20 countries, the increasing corporate profit, increasing wage, declining wage relative to the corporates are all also true for Korea to a lesser degree, to a lesser extent than the average G20 countries, but still it's evident. Also, income inequality has been improving in Korea in the last 3-4 years, but overall, if you compare it against 20 years ago, it has deteriorated. Again, not as much as in the average of G20, but still, it's reflective of what's going on at the global level. Policy response, I think we have to continue with further trade liberalization through a bilateral as well as mega FTAs. We had some progress in Bali package, fortunately. So full implementation of these hopefully will help promote trade and reorient policy to raising employment. Sorry, I don't have time to go into all these details, but just want to lay out what the key policy challenges are. And the final thing is to change the DNA of the economy itself. Essentially, it's more R&D focused, innovation, making ideas sellable, tradable, and make sure in the end, finally, that innovation is translated into FTA. Sorry, TFP, not FTA. I've been thinking of too much recently on FTAs. So, and innovation, making innovation, converting innovations to TFP, it's a very important concept, and it's much more complicated than it appears here. But anyway, let me stop here, and then I'll open up the questions.
Who will be the second person that has a question, because no one wants to be first? We'll wait for the mic to come. If you could stand up and introduce yourself.
Stanley Coburn. I was looking at the U.S. budget figures, and you mentioned the growth of the interest rate burden. They show that in the next 10 years, projection is interest on the debt, public debt, in this country will go from 1.5% of GDP to over 3% of GDP. At the same time, discretionary spending, like on defense and non-defense, will drop by about a third. You can see that the interest payments are pushing the discretionary spending down. This will translate throughout the world, won't it?
Absolutely, yes.
That's my question, if you could elaborate on that.
No, what will happen is that spending in fiscal consolidation in the U.S. will certainly have negative impact on the U.S. economy itself. And therefore, the impact on the rest of the world will be channeled in two different ways. One is through the trade channels, because slower growth will obviously have a negative impact on the global trade. The second channel will be through the financial channel. Not only will it tighten the dollar liquidity condition, but it will raise the average interest rate in the rest of the world. And that will have a very serious impact on EM countries' corporate as well as financial system balance sheets. I have some data on Korea and so on, but what I can tell you at the moment is that if for example, let's take Japan, for example, which is probably easiest. Japanese interest rate, if already its accounts, I think the public debt is close to 250% of GDP. Interest rate on average, I think it's about 1%. I'm not sure 100%, but at the moment, it's accounting for a large share of total revenue in Japan. If interest rate increases, let's say by 200 basis points on average, then it means tripling, and assuming that it sort of passes on half of that, even 150 basis points. Even then, it's more than doubling, right? Ceteris paribus, what that means is the revenue to interest payments as share of revenue would probably go up from 30-40% to double of that, or even more. So the simple just thinking on the potential balance sheet, on the government as well as on the corporate as well as financial system will be fairly large, and it will have negative implications. And that's what I was referring to earlier.
I guess we're both supposed to sit down over there for Q&A, okay. So I'll follow you. We have a next question. come on.
Well, it's salty.
Okay.
Question.
Next question or comment? Way in back.
My name is Catherine Reynolds for the Treasury Department. I was wondering, your presentation was laced with great mathematical analysis, and I appreciate that. But I was really intrigued by what you said about how Korea's problems or issues are reflective of the G20 in general, and that in many of the parameters that you analyzed, Korea's in less worse shape than the G20 on average. I was wondering if you could sort of elaborate or speak about Korea's political economy a little bit and how capable it is of addressing those challenges, and if you can do it against relative to the G20, that'd be helpful as well.
Is this the mic?
Yes, just talk right into it.
Okay. It's too high-tech savvy. The simple answer is yes, Korea will be able to address these challenges. This is the politically correct answer. The current policy thrust in Korea, we are pursuing actively opening up the trade system through FTAs. We've recently concluded, as you know, FTA with Australia. We have expressed interest in joining the TPP, or at least starting the negotiation or discussions. We are also pursuing FTA with China, as well as China, Japan together, RCEP, the Asia. So in other words, we have a lot of things going on the trade side. So obviously, we would like to further liberalize the trade system. That will not only help boost exports and imports, but also it will provide greater competition within the domestic economy as well. So that's one area that we're pursuing. Second area is Korea is also pursuing policies that will enhance competition in the market. President Park is very focused on ensuring that competition in Korea product market as well in factor market is improved. And she would like to achieve that through ensuring the regulatory framework is intact and also the competition, there is no unfair competition in the system and so on. So these things, she made it very clear at the last G20 summit statements. And that's also work in progress. And lastly, but not least, we have a policy established at what we call the creative economy. And that's the last slide that I was actually showing. In the nutshell of that policy is trying to convert innovation into TFP. And that's the shortest and the most probably accurate description of what creative economy is. I'll give you one simple example. Innovation is not equal to TFP. Innovation becomes TFP if it has value added. And that's essentially the key. And that's what she's trying to achieve.
Or over here.
Tom Oakley, National Economist Council. A quick question. With China's recent sort of militancy and sort of the U.S. contraction of the defense budget, and I sort of assume that means that local countries will have to start taking a more share of their own security. Will that impact the Korean economy at all? I mean, I know clearly defense spending has been at an all-time high for the United States, and as that contracts, I think, certainly in terms of NATO and other places, will that have an impact on the Korean economy going forward, do you think?
I don't know the answer. I think it partly depends, not from a political economic point of view, but purely from an economic, positive economics point of view. If defense industry prospers and if it is positive in terms of economic growth, I mean, it could work the other way around. But I don't know the answer because I haven't actually looked into this issue. Yeah.
Dr. Lee, you had discussed in your presentation the need for rebalancing in the world. And since we've switched from the G7 to the G20, this has been one of the major issues. The United States tends to have a significant current account deficit. Germany and China have had surpluses in the trade account. But one of the challenges we face is that to do this, it means, as you mentioned as well, that some countries need to export less and consume more at home, and vice versa. But one of the challenges, and we've seen this as the United States has tried to move towards greater exports, is that many of the countries who have export surpluses do not want to see those necessarily diminish. How do we overcome those sort of broader economic challenges to take and rebalance the economy to a more sustainable level?
I think the surplus countries certainly are not accumulating reserves or are not maintaining surpluses because they want to. Of course, one could argue, okay, why don't they let the exchange rate adjust? Okay, I think if they were to use the exchange rate as a single instrument to allow their trade or current account surplus to adjust, I think the exchange rate will have to overshoot significantly relative to long-run equilibrium levels. The reason I'm saying that is because in many, not all, but in many cases, I think the reason for the current account surplus is not necessarily because of the wrong relative prices, but it's because the recent slowdown on domestic economic growth. And thus, of course, the classical answer to this is, okay, exchange rate appreciation, right? Because you have the exchange rate appreciation and thus the expenditure switching impact. But if they do that, I think, as I mentioned, they need to appreciate too much to balance. So the policies that they are trying to pursue is, while not letting the current account surplus go out of hand, they're trying to boost domestic consumption, and not necessarily through macroeconomic policies using the exchange rate. While this is part of the equation, I think they're trying to do that also partly through structural reforms. And the problem there is, because different countries have different problems, there's some misunderstanding of, whether the right reforms are being implemented or not. And this is thus the key issue that we are going to discuss at the G20 level under the Australia presidency this year. The single most important theme that will be discussed is growth strategy. What are the right reforms that will actually ensure proper recovery or fast recovery in all the G20 members? And hopefully by the end of this year, we'll have some answers.
Good afternoon, Sanjin Choi. Thank you so much for your lucid and succinct and insightful remark. Clarify what you said earlier. You mentioned recycling of US dollar will be tapering off. When you look at US, of course, we had a QE. When you look at EU pursued OMT. When you look at Abenomics, in a way, in the Western invention. My question is, A, how do you foresee Abenomics' third pillar? Will they pursue structural reform? And B, what is impacting on recycling US dollars declining has impacted in BRIC countries, especially in India. I happen to be an admirer of Raghuram Rajan. I think he's making a bold initiative in India. I would be very interested in your views. Thank you.
So, before you give up the microphone, your first question was...
First question is Abenomics.
Right.
Will they pursue
the third arrow.
The structural reform?
Right.
Second question is recycling US dollar tapering off.
The impact of tapering.
What impact on BRIC countries, especially India? And I happen to admire Raghuram Rajan, who you know very well, and he made a bold initiative in India. And I would be interested in your views.
You seem to have asymmetric information. How do you know that I know Rajan?
you want at the fund.
Okay.
You advised the fund, and of course he was one of us who predicted what would like to happen in 2006. Thank you.
What I can tell you is that in terms of the third arrow, I can just repeat what my counterpart, the Japanese counterpart, told me, and that they told me they are going to implement it forcefully. That's all I can say, because...
Please expound it for me.
No, they have various plans, as you know, in various fields that are currently sort of heavily controlled, and not necessarily controlled by the government itself, but they have sort of local industrial level agreements or cooperative, and they'd like to open it up. They'd like to promote further competition in these sectors. To what extent they will be successful, I mean, I have no idea. That's why I was saying that I can just convey to you what I was told. And I actually visited Japan 2-3 months ago, and met various ministries, and what they told me is that they will implement the policies forcefully, and I take their word for it. So, to what extent, how that will actually impact economic growth, that I'm not clear, because not because I don't believe what my colleagues told me in Japan, but because nobody, even in Japan, I don't think they're aware of what individual reforms, even if successful, will actually do in terms of enabling long-term growth, because that's something beyond the normality sort of analysis. So that's all I can say. But the point that I was trying to make is, even before you go into the third arrow, what I'm concerned is that if the financial market the global financial market encounters some instability, the wealth effect may actually reverse in the short run, and that could have very disruptive impact. In terms of the tapering, as I sort of alluded to, certainly if things go as planned, and I have all confidence to believe that it will, and by that what I mean is that the pace of tapering will take place in such a way that it is well phased with the strengthening of fundamentals in the US economy. If that happens, then nothing will happen, because you're essentially replacing the liquidity with fundamentals. Okay, so that's the baseline. On the other hand, if that doesn't take place and something goes wrong, and obviously the dollar liquidity tightening will become an issue, there will be withdrawal, flight to safety, and this time they may not actually include yen, and it will only include dollar. If that happens, then obviously countries like those that I grouped as, I don't know which group it was, but I would put India as one of those groups that will actually revert back to the lower potential. I don't think that again, I'm not an expert in India, but based on my conversation with my colleagues, what I was led to believe is that India was enjoying sort of a temporary boost from liquidity injection, easy macroeconomic policy. But even if there is a withdrawal of liquidity from the market, it doesn't seem to indicate that that has actually built up systemic risk. And thus, it may actually revert back to more stable, somewhat lower potential growth rather than any significant disruption. Whereas there are other cases that I don't want to mention the country's name, where I think the classical IMF program may be required. Sure.
Any other questions?
Sorry, Catherine Reynolds again.
Do you again have difficult questions for me?
Just a follow-up to the current account question, which is a good one. You mentioned that one form of an adjustment would be through exchange rate appreciation, and that you think that structural reforms are another option. How about another direct tool, which is fiscal policy? Could you elaborate on? Korea has a low public debt burden. Could you share views on Korea's potential to boost fiscal spending in the near term?
I think that Korea's policy has already been revealed, essentially, and the position that we've taken and made public through the G20 process is we will take a flexible approach in the short run and consolidation over the medium term. That's our position. How you want to interpret that, well, you may have already noticed that the actual outcome in the fiscal position relative to the initial plan has been relaxed already for last year. And the path has been thus accordingly adjusted. And as far as I am aware, I don't think that we have changed our position from the last summit where our position was made very clear.
Well, I've got a question, and then I want to have Chairman Cho come up here and give a few remarks. What are the indicators that a government may be too aggressive in interceding in the economy?
Interceding?
Interceding, that's correct.
the science government may be too aggressive in
That's
terms
correct.
of interceding. Can you be a little bit more direct? I think
Well, it's
You are-
because there's a
you are after something, and I'm not quite sure what that
well,
is.
I assure you, it's not a trap question. It's not a trick question. But there are many. The debate taking place here in the United States is that the government should step back, allow the economy the opportunity through the free enterprise system to recover itself, as opposed to one stimulus after the other. It's a big debate that continues in this country. And so, at what point are there any indicators in your mind, generic indicators, to show that the government is too aggressive in intervening in the economy?
Well, what I can tell you is my view is that in the short run, if the economy is sluggish and the government does not engage in expansionary policies, that I would see as too little intervention. In other words, if you can see clearly there is a cyclical downturn and the government does not engage in expansionary policies, then that's maybe too little intervention. On the other extreme is if you start seeing inefficiencies building up in sectors, still the government does not slow its direct intervention or influence in resource allocation in those cases, that I would see as excessive intervention. And the latter is usually found in cases where a country is emerging from a low income or developing to more middle income group, where the economic structure itself is becoming a little bit too complicated for the government to be able to plan its way forward.
Well, that was a good economic answer and a good political answer.
You see, that's, I think, what you were... what's the political answer? Well, I think you should answer that question.
Okay. Well, we can do that another time. But obviously, there's a lot of discussion going on in this town as to whether or not the federal government should have been involved in the bailouts. In the end, it cost the taxpayers $10 billion to bail out Chrysler, for example. And with the qualitative easing, every time the Fed decides it wants to back away from that, it's some kind of a ticker going on Wall Street. Some get excited, some don't get excited about it. But that's not your problem in Korea. That's the problem here in the United States. And Dr. Lee, thank you for sharing with us a lot of the insights here. Sure. Chairman Cho, why don't you come on up and share with us right up here? Chairman Cho is the chairman of the Keikman Daily. Keikman Daily. Kumin. Kumin. I would guess, I've got to get my staff to give me a better spelling here on this. But you want to share with us for a few minutes? You have a couple of remarks.
Yes, thank you, Dr. Lee, for your informative and to-the-point perspective on the Korean economy. South Korea's development over the last half century has been nothing short of spectacular. And the success of Korean economy is not just in the past. It is expected to continue in the future. Foreign Affairs magazine recently selected South Korea as one of the 6 hot market global investors should watch over the next half decade. However, it is also true that Korea faces a range of tough challenges. They include domestic factors such as its aging population and the widening wealth gap, and external factors such as the geopolitically unstable region, etc. In particular, I would like to note the weakening connection between the South Korea exporting sectors and its domestic sectors. The exporting sectors is mainly composed of large companies, while the domestic sector is driven by small and medium-sized enterprise and the self-employed. Worry of global competitiveness, big corporations tend to look overseas for their manufacturing bases instead of investing in Korea, where they believe the labor cost is too high. As a result, concern is being voiced that the exporting sector's contribution to Korean economy is not as much as it was a decade ago. Conventional wisdom has it that Korea's exporting sector is the engine of the Korean economy. Fortunately, the Korean government is keenly aware of this challenge. Since President Park Geun-hye took office in February 2013, her administration has been focusing on the development of a creative economy in an attempt to bring together innovative ideas and foster more vibrant startups. And the government is pushing ahead with lowering barriers to the service sectors. In conclusion, I would like to quote a respected Korean economic expert, Dr. Marcus Noland of the Peterson Institute for International Economics. Many Americans expected Seoul to remain a ward of Washington in perpetuity. South Korea, of course, has proudly proved that expectation wrong, and seems like to keep defying skeptics for years to come. Thank you.
Okay, well, we want to thank you. Oh, Jay?
I just want to make a, excuse me.
My former colleague in Congress,
Hey,
Jay
I'm
Kim.
glad to see that.
It's good to see you, member of the 103rd Congress. Want to stand up, Jay?
Yeah,
Jay, why don't you
you've
stand up
always
there?
outspoken, and I remember that. It's not a question, really, perhaps comments that I've been hearing this presentation. Excellent. However, I just got back from Korea, and a lot of Koreans are really concerned about North Korean impact. They are frightened by this North Koreans' ill behavior, and this new leader they have is totally unpredictable, and none of us know what's going to happen to Korean economy, what kind of adverse impact to Korean economy, which no one even mentioned. They might upset the entire chart, predicting what's going to happen in 1915 and down the line. I was wondering whether it's a political question or economic question, but how would somebody address that? Because people believe that because North Korean constant threatening, it impacts the investment, foreign investment, and all the long-term planning also. Anyway, my comments are the North Korean impact. I'd like to see somebody mention that it can be stabilized income continually. Some fortune tell us that North Korea is going to collapse within 5 years. Well, what's that mean? 5 years, 10 years, 3 years? There must be some kind of dramatic impact to the South Korean economy. I'd like to see someone just briefly address that.
You've got about 2 minutes.
Okay.
There we are.
Well, this is my personal view because I haven't actually discussed this with anybody else. But my personal view is that the Korean economy at the moment is facing some difficulties like any other countries, partly because we also dependent on export, and export is waning. But given the policies that we are implementing at the moment, I'm quite confident over the medium term that foreign investors will not come back with negative returns, particularly given the slow growth prospect in the rest of the world. So on a net basis, Korea is still a good place to invest, and I don't think that hopefully that threat military threat from North Korea is as serious as one might actually think. More recently, Kim Jong-un has indicated his willingness to talk with the South Korean government. But then again, Congressman Kim, you are the expert in the political economy, so let me just stop here.
Well, I would concur. I was in Korea last spring, and it was whenever the United States has joint military exercises with South Korea, somebody in North Korea gets all bent out of shape. And as I was there, I turned on television, and a network whose name I will not mention was talking about South Koreans going down into the subways and exercises for some type of a military assault by the North. Well, I was out and they were going shopping. The stores were jammed, the streets were jammed. I called my wife, I said, everything is fine. The saber rattling, continues. But what's very interesting is the fact that you're going to see China, and this is not a prophet or anything. China is very much concerned over what happened to Kim Jong-un's uncle, because one of the reasons why he was executed was because a portion of real estate was sold, I guess, from the Raysun industrial area, and the Chinese were amazed because that's a joint effort. And all of a sudden, it did not make sense to them to have that type of, first of all, have the summary execution like that, and then to use as a reason for that an agreement among the Chinese and the North Koreans as to how to utilize the real estate within that particular industrial area. And so North Korea continues to, at least in my view, bury itself in a deeper and deeper hole. And while that goes on, there's more respect now for Korean ingenuity, investments, with Korean-built cars and Korean name cars made here in America taking a greater market share. So the alliance between the United States and Korea, in my opinion, continues to grow stronger in light of what's going on in North Korea. So, well, thank you very much for coming and sharing. Thank you, Chairman Chobe, and thank you all for coming this afternoon.